In this video, we'll cover everything you need to know to start trading Forex quickly and efficiently. Forex influences every aspect of your daily life, from buying your morning coffee to refueling your car to planning a holiday. All these transactions are made possible by the dynamic Forex market. Plus, we've got a massive discount voucher to start you trading that complements this lesson. Stick around to find out how you can get it later in the video. So, what exactly is Forex? The term Forex is a combination of foreign exchange and refers to the foreign exchange market, the largest financial market in the world. Imagine a vast marketplace where currencies from all over the globe are traded instead of goods. The Forex market is one of the most actively traded markets, with a daily trading volume exceeding $6 trillion. Unlike the stock market, the Forex market operates 24 hours a day, from 5 p.m. Sunday to 5 p.m. Friday Eastern Time. You might be wondering, where exactly is the Forex market located? The answer is everywhere. Forex is a decentralized market with no single central authority or exchange overseeing it. Instead, it consists of a network of banks, brokers, dealers, and even governments trading currencies with one another. Don't forget to hit the like button. It helps us to keep creating more free content on YouTube. Let's dive into some key concepts you need to know. Currency abbreviations. Each currency is represented by a 3-letter code called an ISO code. Here are some of the main currencies traded: USD, US dollar, simply the dollar; AUD, Australian dollar; the Aussie; NZD, New Zealand dollar; the Kiwi; EUR, the euro; CAD, Canadian dollar; the CAD; GBP, British pound, simply the pound; JPY, Japanese yen, simply just yen; CHF, Swiss franc, simply called the Swiss. What is a currency pair? In Forex, currencies are traded in pairs. When you trade Forex, you're buying one currency while selling another simultaneously. For example, consider the pound-dollar pair. The first currency in the pair is the base currency, and the second is the quote currency. If you get a quote of GBP, USD as 1.2675, it means for every 1 pound, you get 1.2675 US dollars. There's always an implicit 1 beside the base currency on the left. When you trade currency pairs, buying, going long, you're expecting the base currency, e.g., the pound, to appreciate while the quote currency, e.g., the dollar, depreciates. Selling, going short, you're expecting the base currency to depreciate while the quote currency appreciates. Major currency pairs. These pairs all include the US dollar, as the US is the world's largest economy. Major currency pairs in Forex trading, such as EUR, USD, Eurodollar, USD, JPY, Dollar Yen, GBP, USD, Pound Dollar, USD, CHF, Dollar Swiss, AUD, USD, Aussie Dollar, USD, CAD, Dollar CAD, and NZD, USD, Kiwi Dollar, are often referred to by unique nicknames for ease of identification and trading. For beginners, we recommend focusing on trading major currency pairs because they are the most liquid, allowing you to enter and exit positions easily and quickly, with tighter bid-ask spreads. What is a pip? In the world of Forex, exchange rate changes are measured in pips. A pip stands for percentage in point, or price interest point. It's a standardized measurement for the smallest whole unit price movement an exchange rate can make. For example, if the Australian dollar is at 0.6771 and gains 1 pip, it would move to 0.6772. Most currencies are quoted to the 4th decimal place, with the 4th decimal place representing 1 pip. However, there are exceptions, such as the Japanese yen pairs, which are often quoted to 2 decimal places. For instance, a 1 pip gain would move the rate from 146.72 to 146.73. There's also a pipette, which is a fractional pip, representing 1/10 of a pip, and it is shown in the 5th decimal place. Before we continue, we want to hear from you. Let us know in the comments below what video topics you'd like us to cover next. And as always, don't forget to hit the like button to help our team keep producing more free videos on YouTube. Lot sizes in Forex. Forex positions are typically measured in lot sizes. A standard lot represents 100,000 units of the base currency. A mini lot is 1/10 the size of a standard lot, representing 10,000 units of the base currency. A micro lot consists of 1,000 units of the base currency. A nano lot contains 100 units of the base currency. Bid, ask, and spread. Every transaction in the Forex market involves a bid and an ask price. These two prices form the foundation for Forex trading. When you want to buy an asset, you will pay the ask price for the base currency. Conversely, when you want to sell an asset, you will sell at the bid price. The difference between the bid and ask prices is known as the spread. Essentially, the spread is the cost you pay to enter the market, covering the dealer's profit and the transaction cost. Different brokers offer different spreads, which can be either fixed or variable. Fixed spreads remain constant regardless of market conditions, while variable spreads can change based on market volatility. Margin and leverage. Brokers offer leverage, which allows you to trade larger positions than your account balance would normally permit by using borrowed capital. Think of leverage like a financial lever. Just as a lever lets you lift heavy objects with minimal effort, financial leverage amplifies your trading capacity. Leverage essentially boosts the potential size of your trades, but it also increases the risk involved. It acts as a double-edged sword, providing opportunities for greater profits as well as larger losses. Leverage ratios, such as 150, 1:100, or 1:500, vary by broker. Margin, on the other hand, is the amount of your own money that you need to deposit to open a leveraged position. It serves as collateral to cover potential losses. While leverage increases your trading power, margin ensures you have a stake in the trade and covers the broker's risk. Choosing a broker. As an individual, retail trader, choosing the right broker is essential to access and trade in the Forex market. A broker acts as your gateway to the Forex market. They provide the platform and tools necessary for executing trades, offer leverage to amplify your trading potential, and supply critical market data and analysis. Without a broker, you would not have direct access to the global currency market, as individual traders cannot directly trade on Forex exchanges. Choose a regulated and reputable broker with a user-friendly trading platform, educational resources, and reliable customer support. Consider leverage ratios and margin requirements suitable for your risk tolerance. Compare spreads and commissions to minimize trading costs. Check for suitable account types, minimum deposits, and convenient deposit withdrawal options. A demo account is essential for practicing without risking real money. Thoroughly researching and comparing brokers ensures a reliable partner for your Forex trading journey. What is prop trading? Proprietary trading, commonly known as prop trading, involves trading financial instruments, such as stocks, currencies, commodities, or derivatives, using a broker firm's capital rather than individual traders' funds. Prop trading firms want to hire skilled traders and provide them with the necessary capital and resources to trade. The primary goal is to generate profits for the firm. Traders typically receive a share of the profits as compensation, which incentivizes high performance. Prop trading offers several advantages. It allows traders to access significant capital, leverage sophisticated trading tools and technologies, and benefit from the firm's research and market insights. Additionally, traders can focus on their strategies without the pressures of managing personal funds. However, it also requires a high level of skill, discipline, and risk management, as losses impact the firm's capital directly. Successful prop traders combine technical and fundamental analysis, leverage, and a keen understanding of market dynamics to achieve consistent profitability. Stick around until the end, and I'll give you a voucher code to get a massive reduction on fees with one of the biggest brokers providing prop trading. Liquidity. Imagine a vast global marketplace where countless participants are trading. Each transaction is so small relative to the market size that it barely causes a ripple, much like dropping a tiny pebble into the ocean. Because of this immense scale, traders can quickly enter and exit positions without significantly impacting exchange rates. In simple terms, a liquid market is one where numerous trades occur, making it easy for traders to buy and sell assets efficiently. Market volatility. High volatility means prices are changing rapidly and significantly, like a roller coaster with sudden drops and steep climbs. Notice the drastic and wide swings in price, signaling high volatility. This indicates more risk for your trades but also the potential for greater rewards. During times of low volatility, the market is calm with smaller fluctuations in price changes, akin to a leisurely ride on a scenic railway. Observe the small price swings, which signal low volatility and imply less risk for your trades, but also lower potential rewards. Many factors can cause market volatility to increase or decrease, such as inflation, market demand, foreign policy announcements, political and economic conditions, economic data releases, central bank decisions, natural disasters or crises, and changes in interest rates. With all these factors influencing price swings, speculating on exchange rate fluctuations is a common way for individuals to make money trading in the Forex market. Understanding the Forex market. So, how do people make sense of the Forex market? Traders often use various strategies, one of which is technical analysis. By studying historical price movements and data, traders aim to identify patterns that might repeat in the future. The idea is that history tends to repeat itself. Think of technical analysis like a detective hunting for clues to uncover how an individual acted in the past to predict how they will act in similar future situations. Here are a few simple examples of technical analysis in action. You observe historical price movements and notice a pattern of higher highs and higher lows, signaling an uptrend. Believing this trend will continue, you look for long trades to capitalize on the uptrend. You see that historical price movements show lower highs and lower lows, indicating a downtrend. Expecting this pattern to persist, you look for short trades to align with the downtrend. You identify an area where the price has consistently reversed drastically, indicating high interest from buyers and sellers. You anticipate that if the price returns to this area, there is a high chance it will reverse again, presenting trade opportunities. You notice that every time the price touches a specific trend line, it bounces off. You expect this behavior to continue, so if the price approaches this trend line again, you anticipate it will bounce off, providing trade opportunities. Another method used to trade the Forex market is fundamental analysis. This approach examines broader macroeconomic and geopolitical factors that influence exchange rates and currency values. Imagine fundamental analysis like creating a weather forecast. As a forecaster, you analyze atmospheric conditions to predict future weather events. Similarly, Forex traders assess factors such as a country's economic indicators like GDP growth, inflation, and unemployment to gauge economic health. Interest rates and monetary policy. Political events and government policy changes. Central bank statements. Breaking news and significant market events. Traders use this information to predict upcoming market fluctuations in exchange rates and currency values, leveraging these predictions to their advantage. Many traders also use an economic calendar to track upcoming economic events or announcements, combining the predicted and actual data in real time. As promised, Best FX Markets have an exciting offer exclusively for our viewers. Unlock a 25% discount on OANDA Labs prop trading challenges using the voucher code 8FMA. This is your chance to control substantial trading capital at a fraction of the cost, massively reducing your amount of starting funds and reducing your own trading risks. OANDA Labs is the ideal partner for prop trading, with over 25 years in the business, a solid reputation for regulatory compliance, and a commitment to the security of your funds, offering robust resources, competitive challenges, and substantial capital to enhance your trading potential. For example, their 10K challenge typically requires a start fee of $169. With the voucher, you'll only pay $126.75 to manage $10,000. Similarly, the Silver Challenge lets you control $50,000 for just $299.25 instead of the usual $399. Take advantage of this incredible offer by following the link in the video description and entering the code 8FMA at checkout. Start trading with OANDA Labs today and maximize your trading potential. That's all for this time. Remember to hit the like button, as it helps our team continue creating more free content on YouTube. Also, let us know in the comments which video topics you'd like us to cover next.